Hi guys, and welcome back to another episode of the Ginger Realtor. We are Market Mondays. It is the second Monday, which means we have Baret Kechian from Loan Depot. Baret, thank you very much for joining us.
Happy to be here.
Baret, let's just jump straight into things. For a lot of people, we're seeing rates now over the 5% point. Should people start worrying that they're going to hit 6, or are we kind of hitting close to what we think the peak will be?
I mean, it seems like it's not stopping anytime soon. There has to be an end point at some point, but yeah, you could worry in the short run that it could hit 6%. That is definitely some things that people have predicted. I can't imagine that's going to be prolonged because I don't think our economy works well at 6, just like it was too aggressive at 2.5. So there has to be a happy median somewhere in there. If I was a buyer that's aggressively looking to buy that has to move right now or needs to move right now, I would consider something similar to like what we've discussed in the past with the lock-in shop, where you lock in at least the worst case scenario for the next 90 days. And then, go shop for your house, something like that would be beneficial for people right now. So kind of stop the bleeding. But in the world of jumbo, you can't do that. So if you're looking for a more expensive house, you don't have that option.
So this is maybe where the conversation we had a couple of weeks ago, where maybe you've taken on mortgage where it gives you a low level and then you can refinance it a little bit down the line, might be a better thing.
That's one thing, but we also have something where if you're shopping for a home right now and you don't have a property yet, we have something where we offer called the lock-in shop, where you can actually lock your rate now with the application in. You would provide us your documents. We would actually approve your loan just like we would somebody with a contract. And the lock is good for 90 days. So as long as you can close on a place, find a place and close on it within 90 days, you get to keep that original rate. And if you don't, you get your $500 refundable deposit right back, and we're back to square one. But for the next 3 months, it would at least give you some level of capping, where right now, let's say the rate is 5 or 5.1, you would cap yourself at no worse than 5.25. So at least that stops you from going to 6, right? And if the rates go back down and we get lucky and they get, let's say they hit a high point and they, kick back, you get the float down. So you get to go back down to 4.5 anyway.
So it's a no-lose situation for a buyer who thinks they can find something in 45 to 60 days and do a 30-day close.
That's exactly it. That's so like it gives something. I have one going right now where the client's locked in at 4.1, and as you said, rates are over 5 right now. And they found a place. They were lucky enough. They've been appraised already. They had a commitment even before making the offer. It was only 5% down. So just even having that commitment letter to make the offer, I think strengthens your chance of getting it. And so for your FHA buyer, your VA buyer, for your 5% down buyer, I think that commitment itself helps. And again, what are you risking? $500 that you're going to get back. Like if you don't find a place, we give it right back to you. And if you close on a loan, we give it right back to you. So it's that's a good one. I know maybe a few companies have it out there. I'm not looking to tout ourselves, but if somebody does, that's a good one to, I would say, like think about, especially if you're like somebody in that $500,000-$600,000 range, that's really up on the high end of your budget.
Okay. So since we last met, obviously the minutes from the Fed's March meeting came out.
Yeah.
I know for a lot of people, it kind of just whooshes straight over their head. But for people shopping right now, what should they be taking from those meetings?
I mean, just that they're basically saying they're getting rid of their balance sheet as quickly as possible, right? So if they're getting rid of their balance sheet, that's all the bonds they bought for the last 2 years. So once they do that, they flood the market with bonds. Nobody wants to buy them. Right now, the 2-year bond has got a yield that's equal or better than the 10 years. So why would somebody tie up money for 10 years versus 2, which is the ones that affect the mortgage market, the 10-year ones? So yeah, we're going to be going through a little bit of a lull here. We have been already. But that being said, yesterday, Sunday, I received, I think, something about 8 or 9 new inquiries, not people that were checking in, not people asking for updates, new pre-approval inquiries. And I think these are very intelligent people that know what's going on in the market. And yet I think they're still willing to look to buy right now because the rent prices are going up just as fast. Yeah. And so I think a lot of people are banking on that refi in the future. They saw it the last 2 years. It was so easy to refi. And everybody was talking about it. They're kind of like, this is temporary. Like, I think that's what I'm seeing. I think it's getting to the point where some people are getting nervous about the payment. Like it is getting to that, that point where like, oh my God. But I think they're still willing to buy. I mean, the calls are coming in at a faster pace than they did last year when rates were at 2.8.
Yeah, and from the realtor side of things, I mean, look, I'm on both sides of things. I moved out of Virginia. I'm renting at the moment because it was a better option than trying to buy something at the peak of the market. But we just listed a house last week, Monday, or 2 weeks ago, Monday, and it went, I mean, within 24 hours, we had 7 offers. 6
Yeah.
of them were well over asking price. So it's not as if the market's slowing down any, despite what seems to be going on.
Yeah.
I have a mastermind group that's Monday morning, and one agent was saying that they had 50 written offers on a listing that went live last week.
Yeah.
So
It's happening.
the market is still saturated as far as buyers over sellers.
Way
So I
more.
don't see it calming down anytime soon.
Yep.
A lot of these doom and gloom sayers who are saying, "Oh, we're going to go into a negative tailspin. The bubble's going to burst. It's like 2008 all over again." It's not. I think if you look at there was an interesting infographic that I saw on the volume of mortgages written over for people under a 620 credit score in the build up to the 2008 crash, and then compared to it since, and
So
just the
little.
volume is just not there.
I could tell you, like, we closed as a team last year, I think, like, I don't know, 1,800 loans. If we had maybe even 5 that were below 620, that's a lot. So, like, as a percentage, it's such a small percentage. And even the ones that were sub 680 were not that many. Not that we don't have the programs for it. We just didn't get a lot of requests for it. So, you're seeing everybody that's applying for a mortgage, first of all, has to have income for the most part. So, like, yeah, you might see some of these, bank statement programs, wherever, but even that bank statement program, somebody's showing you they physically have income coming into their bank statement. So it's something, it's better than nothing. Whereas I think in 2008, I mean, all those no income, no asset loans where you were literally just stating income, which was ridiculous. That hurt the market. I think the crash at that time, it was different. There wasn't as many buyers as there are out there now. And I think there was a ton of investors out there just speculating. And the riskier products out there eventually were going to crash. I mean, you still had negative amortization loans back then and stuff, and subprime loans. None of that has been in the market since. So everything that's been done financially since has been pretty much like conventional loans, qualified people, good credit scores, can afford the payments. And so there's really no reason for a crash. Yeah, there's plenty of equity. I mean, the level of equity in homes right now is the highest in the US that we have ever seen in terms of how much equity that homeowners have.
Yeah,
to tap into that equity is going to be the hard part, because now you're going to have to take maybe home equity lines of credit because you're not going to do a cash out refi at the current rates.
No, and I mean, I just look at the amount of equity that we had built in our personal home back in New Jersey.
Of course.
Like when we bought our house in 2013, it was just our little fixer upper, and to nearly double your money over 8 years is just crazy, especially the way the like. And look, I'm a real estate professional. I like to think I'm reasonably good at what I do, but I could never have envisioned this time last year being able to achieve the sales price that we're in the process of doing.
Yeah.
So it's the market has pushed on way beyond anything I had anticipated. And yeah, I think because the market is so competitive when it comes to the deals that are getting accepted, that due diligence is happening more and more on both the buyer side and the mortgage side, where I'm having that conversation with the mortgage reps on the other side. Look, I need to know that A, they're well qualified, B, you're going to close on time, and there are going to be no issues.
That's it.
And with more and more agents pushing a non-refundable security deposit or equity, escrow rather, into deals, it's just I think we're going to see. I think we've got a little bit of higher rate to go just yet. I know that your guys sent out the newsletter this week that said that in January there was a 2.2% rise in home prices and 20% year on year. And look, 20%, if you got a $500,000 home and you have a 20% increase, that's a huge increase. Like, you don't think about it when you're just looking at, but when you actually break it down as to how much extra and how much further that money has to go, it's crazy.
I mean, there's people that bought homes during the COVID year, 2020, that paid extraordinary prices that I thought they were crazy, selling in Hoboken at that time and buying in the suburbs and paying all that extra money for these suburb homes. And they're probably up 200,000 right now.
Yeah.
In the suburbs in that 2020 to 2022. And so I'm totally wrong. And, I can't believe it. But I think a lot of people misjudged that market, because if they were smart, they would have probably bought places in Hoboken back then too, because you couldn't give a condo away here in, near the city. Now we're above 2019 prices in Hudson County. Wow. And then the market in the suburbs has gone up, 15 to 20% since 2020, when it had already gone up significantly from 2019. So it's,
and the fact that the rental market out there is so competitive. think the
It is.
rental market might actually be more competitive than the home buying market right now.
It is.
And it's crazy
Yes.
the fact that it's I think it's just that dichotomy of life where it's like I can't afford or I can't get pre-approved for a mortgage and have a 1,900, 2,900, whatever the mortgage payment is,
Right.
payment each month, but I can rent a house and pay 25 to 3,500. So you end up paying more to rent than you would
Right.
to buy, but you can't afford. You can't.
It's yeah, I see. I mean, the one good thing, the one bright side is, again, conventional loans end at 647,000. So if this is more for your Jersey market for sure, but in Jersey, like everything kind of ends up over 647 now. So we're using our jumbo financing for any loan amount that's above 647 and has 20%. Those rates aren't bad. I mean, you can still get a 10-year ARM right around 4%, 3.8. You can still get a 30-year fixed at 4.25, 4.3. So those have not shifted over 5. Those are basically mostly what you're seeing is bank-backed products that are on the secondary market that lenders like us have the ability to underwrite and use. And I think we make the process even easier than going direct to those banks by far, because we know their guidelines better than they do.
Yeah,
and so
the one issue I've never had, and I'll say this every week until my tongue falls out, is I've never had an issue with Loan Depot where a loan has failed to materialize because of something Loan Depot has done. In fact, I've never had a loan fail that's gone under contract with Loan Depot. Just never. And that's why we do these videos, because I value your professionalism. I value the insight you bring into it, but also because you're reliable and your team that over there in Hoboken gets the job done.
Ultimately, I mean, it's getting harder, but
that's all we care about. Are your rates good? Are you responsive? And can you get the job done? And these guys do it time and time again.
Yeah, it's getting harder, like I said, because of the jumbo stuff. There's more dots more I's to dot, more T's to cross. But we have a big enough team, and we haven't let anybody go for that reason. Like, I don't believe in just laying off to make profit. I'd rather make less during years like this, but make sure that our quality control is always there, that our clients are still getting great service, because we know the volume will come back again. At some point, the refis will be back, and all these loans we're doing now will be our clients again, but we need to make them happy so they remain our clients and they come back to us. And that's our goal. I'm sure that's the goal for any real estate agent, any financial planner. Like, you want to make sure you provide great service all the time, no matter what. So yeah, like I said, we're going through an odd time in the market right now. I've been at this 25 years and I haven't seen anything like this before, but it's nothing that we won't get through.
But from a rates perspective, it doesn't seem too much different to 2016, 17 when I first got in the market.
No.
And if somebody was getting 4.5, they were like, look, you need to jump on that rate right away.
That's right.
I think when you look at the media commentators, I think they have such short-termism as far as what's going on in their world, that they forget that just 5-10 years ago, these were the average rates. I mean, 4.5, 5 was an average rate.
100%. Yeah, I mean, there's also a lot of younger buyers now that only started looking when rates were so low. So they've only seen 3%, 3.25, 3.3. So for them, 5.25 seems so foreign, but yeah, for someone who's been in it a long time, that's not, or has bought a house previously, like even in 13, when you bought, I think back then rates were a little lower, but then they've
I think we got 3.25 when we bought on our FHA, and the way that we kept it for so long with PMI on, because refinancing it without the PMI didn't make sense to us.
Didn't make sense.
Because we were paying the higher PMI rates. I think we were paying $400 a month in PMI.
That's right.
So
yep,
it didn't work for us at all. But listen,
it'll all come around. You have to just basically make sure you as a buyer, don't ignore those emails that come out from your lender. Keep in touch with your lender, just like you should keep in touch with your realtor about the values of homes and things in the area. Just be knowledgeable. And then, not that we don't always keep in touch with our clients, but they should also do the same, because whatever you close on now will not be your loan in 7 years. Almost no chance.
And look, let's be honest, what you close on now at 4.5%, 5%, if the rates go back into the 3s, it may well be worthwhile paying that application fee, processing the refinance and dropping your payment, because the difference of that 1.5%, 1% over 30-year mortgage is ridiculous.
Even a 0.5%, you'll do. Like in most markets where the loan amounts are 400 to 450 or those types of numbers, you would do that for a 0.5%, as long as you're talking about a $3,000 refi cost, especially rolled into the mortgage. It's even 0.5%, you're going to see people jump into it, because you can always just do it again. Worst case, if it comes further down, it's almost like take a bird in the hand as opposed to hoping for two in the bush.
Yeah.
And you'll see that. I think that's you just make sure you get a reasonable price on a house. even if you're going over market, that doesn't mean anything right now, because that doesn't necessarily mean that's the wrong price. That just means that's what the market is. So meaning in the future, you'll hopefully get that back. Don't buy a house for 2 years, right? Like, I'm sure you advise people, like, buy a home for the next 5 to 7 years and know that you're going to be there, and eventually the market will come back to you, even if there's a short term. So yeah, I think it's that's what we're seeing in 2 weeks. Hopefully, when I'm talking to you, we'll see a 4 in front of some of these numbers again. That would be something. Every little
Fingers
bit.
crossed. Baret, so for those of you who don't know, I'll end up putting your information below you, so it's there. But for someone who wants to reach out to you and start the mortgage process, what's the best way to get in touch?
To be honest, like, if they just shoot a call through my cell phone or office phone, they both go to my office. We have 7 of us here at all times. There's never a time they won't get a live person if they want one. I have no voicemail messages, because there's always someone that can handle something at an immediate time. And all on my team, we all work together. So that's the easiest way.
So we'll have Baret's information. I would say it's going to be underneath him there. I know it doesn't look right from this call, Baret, because I'm on the right and you're on the left, but I switch it around, and hopefully I'll get it right this time. It's like
I'll take your word for it.
Well, Baret, thank you very much for coming out and taking the time to speak with us again today. We will see you in 2 weeks' time. Folks, that's all we have time for today on the Ginger Realtor Market Monday show. Next week, we'll be back with Eric Klein, who last week took a well-deserved break. But for me and from Baret, thank you very much, and see you next time.